Welcome back to the studio. We are so delighted to welcome to our studio some of the speakers who were just involved in the debate live in the plenary. Where should net zero investors be putting their focus to keep 1.5 alive? And we're going to be posing them your questions that you can submit via Slido, which you can find on the right-hand side of your screen. Just make sure to select Live Studio when you submit your questions. So welcome so much, fresh off the stage, fresh off your debate, we have Jake Barnett, Managing Director, Sustainable Investment Strategy for Wespath, Mirza Baig, Chief Sustainable Investing Officer from Aviva, and finally, Nazmeera Moola, Chief Sustainability Officer for 91. So welcome. Thank you so much. There was a fascinating debate that went on there. Nazmeera, congratulations for winning.
Thank you. It was a team effort with Anne.
Yes, sorry Anne couldn't join us, but we're really grateful to have you here. And we wanted to continue the conversation. Obviously, there were already lots of questions there in the plenary, but we're going to go straight to the questions from our audience, if that's okay with you. And feel free to jump in on any of these questions. So the first one is this is on the premise, is it still helpful to talk about keeping 1.5 alive when the consensus seems to be that we're going to overshoot that target?
I could start just by saying, I think sometimes the finance industry has a tendency to become overly fixated on the numerical factors when you're talking about an unprecedented transformation of the entire economy in the next 25 years, as we've heard about time and again, I think there needs to be a certain curiosity and humility about how you approach that. So part of what that looks like is, I think that there's a broad consensus, especially amongst this community, that it's directionally correct to rapidly decarbonize and that we're not on track. So I would challenge people to become more focused on what you can do in the short and medium term to actually enable your commitments and less concerned whether we're going to be hitting those exact commitments in 25 years.
Would both of you agree with that?
Yeah, I mean, I think we want to keep ambition high. And my fear is that if we say, okay, we can't do 1.5, let's go for 1.8, we'll actually end up with 2, the slippage continues. So I'd rather keep the ambition high at 1.5, bearing in mind Jake's excellent point that it's about the direction and with sufficient energy behind the direction.
And what about the risk, though, that if people think it's not achievable, they kind of check out of that conversation?
I think there is some risk around that, but weighing up the two sides, I think there's a bigger risk of persistent slippage as you downgrade the ambition. That presents higher risks to me than people starting to think, well, we're not going to achieve it, so we give up. I think there's enough awareness, and the recent weather in the US shows that we need to do something. So let's maintain the ambition.
Fantastic. Thank you so much. Now, obviously, the main argument there was about policy engagement or company engagement. And we have a relevant question. If the argument against policy engagement is speed, the logical outcome to argue for startups that focus on disruptive innovation and will move fastest. Why then is our approach to focus on getting large corporations with status quo bias on frameworks rather than focusing on more innovation funding? Who wants to take that?
Yeah, I agree. Look, I think it was Anne that made the comment that governments move slow and what we need is rapid change. And I agree in one regard that, yes, governments do move slow, primarily because there's so many stakeholders in that decision-making process. But the reality is that once governments move, then the action that follows is rapid. So even when it comes to scaling technology, the UK government announced just last week a 20 billion commitment over the next 20 years in building out carbon capture and hydrogen infrastructure capabilities in the north of England. And that's been part of the government agenda for some time. But the moment that that's announced, they're now looking at crowding in an additional 8 billion in private capital. And that acceleration just simply wouldn't have happened without the government taking the first step. So, I mean, as we talked about in the debate, it can't just be a single sort of dimensional approach to change. The challenge is too enormous, but we do see that governments catalyzing and triggering the first step will be instrumental, particularly for scaling of technology, which is not economically viable today.
And you made a very compelling case there in the plenary for these policy changes. You talked about EV policy. Are there other key policy areas that you'd like to see these changes featuring?
Well, I mean, if you think about decarbonisation, it affects every single sector and every single industry. So, I mean, we talk about EVs and transport, that's ground transport. What about airlines? That's 2 to 3% of global emissions. Now, we've already got the technology, sustainable aviation fuels, to go significantly towards decarbonising the industry. But there's a supply component, there's a demand component, and there's a regulatory component. So right now, I think regulators are moving towards a step change of 10% of a mandatory SAF involvement by 2030. The problem is that we don't have the supply at this point in time. So we need a whole of government, whole of economy approach where we look at every element of the blockers of that change. And corporates are going to have to play their part. Consumers are going to have to play their part. I think it was Lufthansa that have already started talking about increasing their prices to absorb some of that additional tax. And governments are going to have to play their part in helping and facilitating that infrastructure build out to allow that transition to take place.
Fantastic. Thank you so much for elaborating on that one. So our next question. What escalation action should be taken on oil and gas companies backtracking on their commitments, as we've seen with Shell and BP? Does that not highlight that engagement with companies has not been successful? Who would like to comment?
I'm going to be a little bit contentious and say one of my main learnings out of the Shell and BP experience is that we've spent far too much time focusing on the supply side of energy and not the demand. Is energy at the moment, I think of as a trifecta of issues: climate, energy security, and affordability. And if all we're doing is focusing on supply, which was what the engagement with BP and Shell was about, we want you to reduce your output, we then run into an issue where the Ukraine invasion happens, plus global growth picks up, and prices go through the roof. And it's no surprise that we're starting to have an increasing turn towards more reactionary nationalist governments in various parts of the world. And a lot of it, I believe, is driven by the cost of living crisis, where energy is a big input. So I have increasingly come to the conclusion that we can't ask oil companies to run themselves to zero unless we change the incentive structure. Asking them to somehow become renewable energy companies is questionable. Some can, a lot can't. It's a totally different business. So the best thing we can do is ask them what they're doing on their lobbying. What are they doing in terms of government policy? And when Shell tells us they are best positioned to take advantage of an accelerated transition, then what are you doing to make that happen? That's what I think we can hold energy companies accountable for.
Absolutely. Now, Jake, you were talking about lobbying, obviously, in the plenary, but you were talking about the need for investors to be courageous in their lobbying. And that was that of policymakers?
I think it speaks to all of the strategies that we're talking about. You know, I have a saying that my wife and I talk about, which is, I think in this industry, if you're not pushing hard enough, that if some stuff goes sideways, I would use if I had a glass of wine, I'd say it differently. But if some stuff goes sideways that you could get fired, I don't think you're pushing hard enough. I think given the scale and the urgency of the crisis that we're facing, it's important to do more. At Wespath, we are a co-lead on the Climate Action 100 Plus engagement with Chevron. And we, at a time when anti-ESG was ramping up, decided to file an exempt solicitation specifically targeting the executive chair and the lead independent director of Chevron talking about their lack of climate alignment on lobbying practices. Because I completely agree with Nazmeera. When it comes to if they're meeting a supply that is necessary for society to function, we can't tell them not to do that. But if they are disrupting demand destruction that's necessary for our long-term systemic interests, I think we need to be much more assertive in saying that that's not acceptable. And one of the lessons that I had from that is it didn't get a great vote. And then, it wasn't something that we really continued on with. But one of the most illuminating aspects of it is I went around to all of our asset managers and I talked to them about, why didn't you vote for this? And I leveraged that also with a conversation, especially with our largest holders, where I had them fill out their alignment with the alignment with climate policy engagement piece that we were putting forth. And I'm trying to advocate internally at Wespath that we be more assertive in looking at those types of leading edge questions on alignment as part of who we want to partner with. And that's putting me sometimes in uncomfortable positions with my CIO, with my asset class leads. Like this is not the stand. I think part of what we saw in the plenary debate is like, this is not the standard for policy engagement right now. But I think it's necessary, and it's necessary for us as professionals to put ourselves sometimes in uncomfortable positions to try something new, because the industry needs new in order to fulfill these commitments.
Fantastic. Thank you so much. Yes, we want to encourage you all to have those uncomfortable conversations that can actually get people thinking about changing their approaches. Okay, the next question. We are already seeing physical climate risks having real-world impacts across the globe. How can we accelerate global adaptation finance to protect economies and societies?
I think, do you want to?
No, you go.
Adaptation finance is hard because in many cases, not all, there isn't a immediate revenue stream behind it. The reason mitigation finance is something that fitted into the financial architecture is you're producing electricity and you can get paid for the electricity. Initially, you needed a subsidy with that. Increasingly, you don't. Adaptation is preventative and protection. It's building a dike. It's building higher flood walls. And it's easier building it into new infrastructure projects. For currently revenue producing infrastructure, that is something that can be financed because they are lowering the cost of their insurance premiums. But in a lot of areas, it's a lot of poorer neighborhoods. In developed countries, it's a lot of poor countries in the emerging world that are most vulnerable. And there isn't an immediate revenue stream that you can borrow against. So this is why you end up with proposals like the Loss and Damage Fund, which is great in theory, tiny in the amount of capital that's been allocated to it, and difficult to dish out given those constraints. So I think adaptation finance as a whole is something that governments are going to have to bear as a public good. And where they can't afford it, we're going to need to find a way to provide some global support for it.
Mirza, did you want to add to that?
I was going to say the same thing, but less eloquently.
I'm sorry that I jumped
So
in.
nothing more to add, but that was great. Thank you.
Okay, well then let's go to the next question. How do you think the Net Zero Asset Owner Alliance's work on policy can become more widespread and adopted into investment mandates and expectations alongside corporate engagement?
I think that at the end of the day, part of what's required is us within the sustainable investment and responsible investment functions at asset owners, really advocating, building relationship, building use cases, building credibility with our due diligence teams and with our chief investment officers such that they see and are bought into the logic that this is something that should be incentivized within the mandate. Something you consistently hear when you start talking to asset manager community peers in these different conversations is effectively like, listen, it's great that you're asking me for this, but I don't hear about it when I am in the room with your deal team, with your CIO. Like, it's not something that's always coming up. And I know there's exceptions to that, and we're certainly working at Wespath to make an exception to that within our own structure and system for asset manager selection, appointment, and monitoring. But I think we do need to do more work on that regard. As one of my friends likes to say, I try to be a thumb guy instead of a finger guy. So I think this is one where we got to take accountability and try to push harder.
Fantastic, thank you. Did you want to add to that, Mirza?
Yeah, I mean, just from an asset manager point of view, I mean, look, we live in a world of fee compression. So asset managers are in a cost-cutting phase generally. But there's three things that we respond to: investment performance, asset flows, and regulation. Those are the three things that are going to drive an investment. And I have to say, right now, while we hear conversations at a Net Zero Asset Owner Alliance level, it's not a factor in manager selection. And therefore, if you are running an asset manager and you're looking on where you're going to invest your scarce resources, there's very little direct return. So that goes to public policy work or just broader engagement. It absolutely needs to be a more central part of manager selection, and then you will see that start flowing back into resources.
And I think you actually see multiple practical dynamics playing out in the reason why there's an offset of why the anti-ESG folks have been so successful. One, they were very loud and aggressive in a way that most fiduciaries aren't comfortable doing on some of these issues. So you're going to see slower movement from those of us that are trying to take prudent approaches to this. But ultimately, I think that community represents a much bigger pool of assets than the relatively de minimis institutional investors in terms of the global scale of assets that have been raising the most noise relating to some of these factors. So it might take some time to bake into the system. We need to push to make it go faster. But I'm hopeful that through some of this work, the buy signal will become more and more clear that this is a material consideration for who we want to partner with as asset owners.
What a fantastic point to end on. I'm afraid we're out of time. Jake, Mirza, Nazmeera, thank you so much for continuing this fantastic conversation for the plenary and making time to answer the fantastic questions from you, our audience. Sorry we didn't have time to answer all of them, but we really appreciate you participating. We hope you've really enjoyed being with us for day 2 and all the fantastic guests and speakers that we've had for you. And we really look forward to welcoming you back tomorrow. So we look forward to seeing you then.